Better System Trader, episode 57.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Welcome to the Better System Trader podcast. This is episode 57, and I'm your host, Andrew Swanscott. Trading algorithmically based on sentiment data is a relatively new field compared to more established approaches. With the explosion of social media and computing power, the analysis of sentiment data has also increased, with some hedge funds committing considerable resources to researching the applications of sentiment data in trading. However, there is also some skepticism of the value of analysing social media for trading. So, what is sentiment trading all about? Can sentiment actually be used in trading models, and if so, how? Our guest for this episode, Dr. Richard Peterson, has been analysing sentiment for over 20 years. He started what was probably the world's first fund specialising in sentiment trading, and now runs a company called MarketPsych, specialising in the collection and analysis of sentiment data. In our chat today, you'll learn why sentiment is so important and how it can give traders an edge, the challenges of using sentiment data in trading models, the best and worst markets for sentiment analysis as a predictor, the applications of sentiment analysis in quant models, and the future of sentiment analysis. But before we get to the chat with Richard, a quick word from our sponsor, MarketSystemAnalyzer.com. Market System Analyzer is a software product designed to help maximize the performance of your trading strategies. It can be used to analyze and provide detailed performance statistics, find the optimal position sizing to reach your trading goals, detect over-optimized trading systems and prevent curve fitting, assess the sensitivity of trading results to trading order, and it also contains features such as Monte Carlo analysis and equity curve trading. So it's got loads of great functionality for traders, and at MarketSystemAnalyzer.com you can download a free, fully functional 30-day demo. So head over to the website MarketSystemAnalyzer.com to check it out. And now on to our chat with Richard Peterson on trading with sentiment. Hope you enjoy it. Thanks for joining us today, Richard.
Oh, great to be here, Andrew. Thank you for having me.
Okay, great. So can we please start with a little bit of background on yourself?
Sure. So I got started in systematic trading in the mid-1990s, back when neural networks and genetic algorithms were sort of the artificial intelligence on Wall Street kind of standards back then. And there was a lot of overfitting. There were a lot of computers we thought were fast that were actually pretty slow when you think about today's computing power. So but back then I did a electrical engineering undergraduate degree, and my senior project was to develop neural networks that could predict financial time series. So basically predicting the stock market and corn futures and cotton and things like that. Yep. And at the time when I was working on these models, I found some strategies that seemed to be pretty reasonable. But I noticed something when I would apply them in the markets. Sometimes I just really didn't trust the system's output. For example, if the stock market was falling and the commentators on the TV were very negative and my system gave me a buy signal, I just couldn't stomach taking the buy signal, so I often wouldn't. And looking back after a couple of years on that trading record, I realized that those trades I had missed were often, on average, the best trades if I had taken them, and that lack of performance was very significant, and that if I could somehow capture this element, which is essentially sentiment, that was driving me to make the same mistake that probably everybody else was making. If I could capture that, then I could probably make much better trading systems. So from that point, I decided to dedicate myself to understanding how, number one, how humans make risk-related decisions in finance, from the brain level to the market level, so that I could, number one, help others and help myself to make better decisions as a coach. And number two, so I could develop better quantitative systems through this understanding of how people react to information and why we again and again collectively seem to make the same mistakes. So that's the basic background. There's, of course, much more to it, but that's the general idea.
Yeah, great. So perhaps if you can just give us a little bit of detail around what you're doing now so that we can bridge that gap, and then we'll start talking about trading on sentiment a little bit further.
Sure. So from those early experiences with quantitative systems, I decided that to really understand the biology of decision making, I should go to medical school. So I did that, went to medical school, and then did research in medical school on the social psychology of bubbles and panics with an impulse control disorders professor. And this was during the dot-com boom. So it was pretty entertaining chatting with him about what was happening in markets. But at the same time, watching people who really did have impulse control problems making lots of money by following penny stock boards and things like that, which became very fascinating to me. And one day at our weekly poker game in medical school, I'm talking to a guy who just bought a new Jeep Cherokee on his weekly earnings, and I said, "Well, how did you do it?" And he said, "Well, I'm following these guys on this penny stock boards." So I started looking at what he was doing, and you know what social media is like. It can be pretty toxic and pretty polluted and pretty noisy, and a lot of people uninformed with loud, uninformed opinions. But you know what? If it moves the price, that's what matters. So I thought about, well, maybe we could engineer a system that could pick up on these conversations that were clearly driving stocks at that time. And also I got into penny stock trading myself and found it to be very, lucrative actually for that purpose. So I became very interested in how could I automate this process and not have to sit there and stare at the message boards all day and try to figure out who's scamming and who knows what they're talking about. So that's when so I got the idea to develop some quantitative systems, but related to sentiment analysis. But I didn't actually do it until I was in my psychiatry residency, and I ended up doing a postdoc in neuroeconomics. And so we were studying how people made financial decisions on the brain level, looking at what activations in the brain, essentially predicted whether they would take an optimal financial risk or a non-optimal risk. Meaning, if we gave them a gamble where they actually knew the odds and knew the potential outcomes, which we don't know in the financial markets, but if they actually did, sometimes people still wouldn't take the advantageous decision. And the question was why? And very often it was because of the information they got about the gamble. So whether they had a negative experience, earlier, if they had just lost money, they would be less likely to bet on a coin flip, even if the expected value of the coin flip was higher, say $30 versus. So let me give you a quick example. So say that we had a coin flip experiment where they could choose not to take the coin flip and they would be guaranteed to get $10. But if they took the coin flip and it landed on heads, they'd win 30. And if it landed tails, they'd win 0. So the expected value is 15. So if they had just lost money on a prior experiment, they were much less likely to take the coin flip. But the odds are the same. It's not rational that your prior outcome, your loss, would affect you. So I became very interested in not only, that they had lost money, but also how do we talk about this gamble? Do we talk about it as, well, it's a coin flip, it's a risk that you're going to take. You might not make any money. Or we could say, you're taking this gamble, it's a coin flip, you might actually make $30. And the way that it was said, even though the outcomes and the odds are right there in front of people, would dramatically distort how people make risk-related decisions. So I became very interested in the words that people used and started mining social media in 2004 and also news media. Started mining them for these psychological indicators that would predict what our market's going to do next. Things like the amount of fear that people use or the amount of uncertainty, and quantifying those factors. So we, in 2006, we set up so at that point we had some software developers working with us. And in 2006, we set up a small, paper trading portfolio. And we sent it to some people on Wall Street so they could watch its performance. And it actually did well. And then we had an article written about it in a Popular Science magazine, and then got some interest from angel investors and fund investors. So we started a small hedge fund in September 2nd, 2008. So right on the edge of the crisis, we launched. And then that Friday, Fannie and Freddie failed, and a week later, everything else failed, basically. So it was an interesting time, but our strategy, while we lost money that first month, did very well through the crisis. And in fact, in the first 12 months, it was in the top 1% of hedge funds trading on a social media-based market-neutral U.S. equity strategy. It was purely quantitative. So we knew we had something, but in the second year, markets changed. So we weren't prepared for the regime shift from crisis to green shoots. And our models didn't adapt. So we didn't have very good adaptive systems at that time. And we ended up losing. So in 2008, we made like 5% at the end of 2008. 2009, we made 30%. But then in 2010, we lost 8.5%. And so we had to close the fund because we were losing our investors. And there was no way back then to get new investors, especially with a new idea. People were very risk averse. So we then branched off and joined with Thomson Reuters to sell the data. And so that's what we've been doing. For the last 5 years, we've been working on the product, making it better and better, adding more and more information sources, covering more and more assets, and identifying which ones seem to be the most predictive across assets. So that's really what we've been working on the last 5 years.
Okay, if we can just have a quick chat about data, because there's so much data available today, and we're kind of a little bit spoilt for choice. So which sources of data do you think can be used for sentiment analysis?
So we've tested a number of sources. We've got 2,000 news sources that we use, and we've got 800 different social media sites like Twitter, StockTwits now, some others like Yahoo Finance, for example, and then quite a few Australian boards actually as well. So what's interesting in all these sources, in general, of the high volume sources, Twitter seems to be actually one of the best. Surprisingly, given all the noise in Twitter, if you clean it up, it's quite good. And then second place seems to be StockTwits, and third place are some blogs, some blog feeds we get. Yahoo Finance is pretty weak, unfortunately. Then in the news space, a lot of the larger the publication, generally the more influential they are, but they tend to have faster reactions in the market. But there's a lot of other publications that create reactions that are much slower. So it's a difficult thing, and to be honest, people can spend decade looking at what are the best sources, who are the best authors, and by the time they figure it all out, it's going to change again because markets change and people's accuracy changes. So one thing that we've done is we just aggregate everything together, and we're looking at so there's a lot of different kinds. It's kind of an interesting field, sentiment analysis, because it's one phrase, sentiment analysis, but the truth is there are people who do event related feeds like data miner, where you're looking at specific, breaking news, terrorist attack in Brussels, that kind of thing. And then you have, oil pipeline leakage, that type of thing. And we do that actually also, but our real expertise is doing, really trying to understand how longer term the tones, overall feelings in the news and the media create longer term effects. So longer term being from a day to a week to a month to even a year. And we found a number of funny little things like we measure, for example, the sentiment about the management team. And we have a very specific kind of sentiment, trust, that we measure, in people's conversations about the management team at a particular company. So every time somebody says, "Oh, Tim Cook is reliable. He's a great guy," we assume that they are expressing some trust in him. If they say something like, "Oh, he's a crook, he's a liar," then it's mistrust. So when we look at that specific type of sentiment about the management team, we find that over weeks, months, and years, if you buy the companies with the least trusted management teams, they generally significantly outperform those with the most trusted management teams. So, it's a very contrarian finding. And we find lots of these really interesting details with our specific type of sentiment analysis. But like I said, there's a whole variety. Most sentiment analysis is really just focusing on positive and negative. We tend to focus on positive we tend to focus on emotions and very specific nuances that are known in the academic literature to have some significance, whether it's uncertainty or urgency or other small factors.
Yeah, I imagine that must be quite a challenge to be able to pick up some of the nuances of language, for instance, sarcasm or perhaps negative news that in context could actually be a positive matter. So, I mean, how do you go about accounting for those type of little details when you essentially analyzing text, I guess?
Yeah, it's funny. Sarcasm is a great one. Early on, we noticed that our joy and anger indexes were highly correlated. And so we thought that's really strange. So we started pulling out the joy and anger. And we noticed that what was happening was people were insulting each other. They would set each other up, and then they would tear each other down. It's like, for example, they'd say, great trade, loser, or way to go on that call, moron. and we'd see that a lot. So they'd say, way to go, expressing joy or enthusiasm, and then insult the person. So we realized, well, that's sarcasm. So we had to add specific filters for that kind of commentary. But, amazingly in social media, maybe not amazingly, but if you've ever looked in social media, it's an enormous, more than half of all enthusiasm is related to tearing somebody else down. Uh-huh. So should give you pause too if you read social media.
Wow.
Don't take it seriously.
Okay, so what about we can often see rumors in social media, news that's actually reported wrong, or perhaps it's an old bit of news, and we also see instances where accounts are hacked and they're creating news stories. So can you share some examples of what can actually go wrong with a computer analyzed sentiment analysis?
Oh yeah, sure. So when we do deduplication, we found some really interesting findings. There's a lot of things that can go wrong, by the way, many. So I'll just give you one example I thought was kind of interesting. We were looking at We saw messages that were coming through that were all identical, that would come from different users all at the same time. Things like great trade or good idea or wow, that was interesting. Or comments like that. And we noticed, we looked at where these comments were coming from. And what turned out there was, different users, but all on different message boards. And they were all posting these comments simultaneously to cultivate a human following. In message boards or in Twitter, different places. So they were cultivating a human following, and they did this literally for 12 months. Then at the end of 12 months, after cultivating a human following, they would put out hints like, oh, hey, did you check out XRGS? Or, I'm making up a ticker. I don't know if that's actually a ticker. They would make XYZQ. Check out XYZQ. Something's interesting happening there. And sure enough, they'd probably been buying the shares. They had gone up, a few percent. And then, wow, look, XRZQ is really moving, and oh my God, why is XRZQ up tripling today? And people trusted them because after a year of their benign comments, people trusted these robots, and people were buying it. And it was a massive, sophisticated pump and dump schemes. Mm-hmm. So those are happening on Twitter and Yahoo, and they're very interesting. They're very sophisticated. In fact, by me saying this, I'm concerned they're going to start, changing the way that they release them, because right now we can block them, but you never know. They always seem to find their way through at times.
It's interesting. I wasn't aware that kind of thing was all automated, and it's interesting to know.
You wonder who you're chatting with.
Yeah, exactly.
It's human or Watson, IBM Watson, trying to manipulate you or something. You never know.
Okay, if we can just switch to markets now. Do you find that sentiment analysis is more effective in specific markets? Good
question. Well, we do. But it's tricky. So sentiment analysis, so for example, commodities, it's difficult to analyze across commodities. So if we create a basket of commodities, oil to cotton to corn, and then we look for, what features of sentiment are predictive, we don't really find anything. But part of the problem in commodities is that your producers and consumers have different feelings. When oil prices go up, the media is generally negative about that, unless you're in the Middle East and the media is positive. Or in an oil-producing country or location. So it's tricky. So you have positive and negative balancing. So what we do is actually break it down into where people say the price is going to go in the future. So if somebody says, I think oil prices are going to go up, or I think, the price is going to take off or something like that, we categorize that as a separate type of sentiment called price direction or price forecast. We have two of these. We find that those are quite significant in commodities, that when people are all talking about the price going one way, it tends to reverse and go the other way. And you can quantify that. And this is kind of an interesting phenomenon. And then we see with currencies, there tends to be much more momentum, and they tend to be much more driven by macroeconomic events, obviously, with currencies. But there's quite a bit of momentum in currencies. So you can really jump on, economic growth that's being talked about in the media that maybe hasn't come out in the GDP numbers yet. But you can pick it up in the media first. So we've created some really interesting global economic predictive models. So every day we get an update on what's happening economically around the world through the media, based on what the media is saying. And we created our own, PMI simulations that are quite accurate in predicting where the flash PMI will be next time it comes out. So there's those types of models. And then but generally the bread and butter of this type of work is individual stocks, because in stocks you have 90% of people long on average, 10% of people short. And usually the people chatting online are long. So you get a very clear directional bias, and you get some really good, you just get some really good sentiment, predictive sentiment out of that, out of stocks. So stocks are quite good typically.
Could that also be because perhaps the mix of market participants might be more towards the retail side in stocks and the professional or fund in other markets? And do you find that perhaps retail traders or investors have more extreme emotions, so the sentiment analysis can work better that way?
I think that's part of it. Yep, definitely. Professional news services don't report like, "Hey, I'm really angry with Tim Cook's statement today." But yeah, on social media, obviously they'll use much more colorful language to say how they feel.
Yeah.
In fact, they won't say "I'm angry." They'll say, "Screw Tim," that kind of thing.
Yeah.
So we have to modify our language analytics between news and social media. We have different ways of calculating the same emotion in each source. So we actually have separate engines, and we produce separate feeds, one for news, one for social media. But also interestingly, so in the United States, sentiment is contrarian typically after about 24 hours. So there might be 24 hours of momentum, especially with fundamental related sentiment. So we track fundamental sentiment about the balance sheet and the income statements, et cetera. When that's positive, that tends to be good for a stock, especially for the next 24 hours. But after a week or so, things really revert. There's a big, strong mean reversion. But some places, most places, including Australia, you see that the sentiment is predictive. It tends to be predictive for a week or even a month. So there's a long momentum effect in most markets, except the United States, and not so much in the UK either. The UK has quite a few reversals, in Canada too. But other markets, I guess generally smaller markets, have much more momentum in them, in the stock prices.
Okay. Now, you've actually developed a market sentiment data feed called the Thomson Reuters MarketPsych indices. I think I got that right.
Yes, that's right.
Can you tell us a little bit about that?
Sure. So in that feed, what we do is we every minute we pull in 2,000 global news sites and 800 social media sites globally, and we're looking for references to all major all tradable assets in those countries and in that media. So commercially, we send out data on about 10,000 entities, so about 9,000 stocks, 130 countries, including macroeconomic indicators, 35 currencies, 30 commodities, et cetera. So there's a lot of coverage. And then internally, we're actually covering every currency and 200 plus commodities. So it's a really big operation. But what we do with that then is we monitor not only the sentiment, like positive versus negative references about that asset, but also the nuances. So do people say the price is going up or down? That's our price direction indicator. Or are people talking about interest rates rising or falling in a country, or inflation going up or down in a country in the future, their expectations? So we pick all of those up. And when you look at millions of articles a day, you can create a snapshot, a composite of what people are saying and how they feel or think that day. What are their beliefs that day? And when you average that together, you get some pretty good indicators for where asset prices are likely to go. I mean, I think we all know that information moves markets. I mean, that's what, there is information that comes in, and then there tends to be a feedback effect and people thinking about it, and the information and the reverberations of it. But fundamentally, it's news that moves markets and our reaction to that news. So that's really what we're trying to capture is the qualities of the news that move traders. And how can we pick up on that before traders have actually moved? So how can we pick up on the information characteristics that move traders? So in our data feed, we have one for social media, one for news. Both of them go all the way back to 1998. So it's a really long history for backtesting. They are delivered through Thomson Reuters, so it can be not so easy to work with them to get the data, to be quite frank. We've worked through Thomson Reuters for a while. Once you get the data through them, it's very professional and very well done. but it can be hard to actually get a hold of a trial. So if anybody wants a trial who's listening, please email me directly, and I'll get you in touch with somebody versus trying to go through the usual channels.
Okay, great.
Which can take a long time.
All right, we'll get your contact details at the end of the chat, and I'll put them on the page if they want to get in contact with you. So,
sounds good.
Yeah. So once you've got that sentiment data, do you mix that with other types of data, or is it best to just use it on its own?
That's a great question. So this is another one of the areas that's really interesting in this field. I mean, there are so many sentiment companies, and each one actually does something different and uniquely valuable. So there's some companies that look at only the Twitter users that have had the highest correlation with returns, in the past year or something like that. So they'll extract those. And so they're basically machine learning on who's the best predictor in Twitter. And they send out a feed like that. And then there's others who look at what are the words that are used in the media that are the most predictive. So they essentially have an event study, ongoing event study. And then they send out sentiment based on what words were most predictive of a given direction. I don't trust that particular methodology. And the first methodology, I also have some quibbles about. But again, I mean, there's so many different ways to look at this information. That's interesting. We group it all together. We're looking at volume. We're trying to look at very liquid assets. I mean, ultimately, when you're trading, you don't want your strategy to get arbitraged out. So we're looking at how do you predict big moves, like, over the next day to month in a big liquid asset like crude oil or natural gas or cotton or the S&P 500, FTSE. So that's really what we've been looking at.
Okay. Now, you've already touched on this a little bit, but perhaps you can give us some more information on, so the sentiment data or the application of that data. Is that more trend following or mean reverting or contrarian? Or can you give us a little bit more insight into what you found there?
Sure. Yeah. So over the short term, sentiment generally is it's momentum driven. So from 10 minutes to 24 hours or so, you can see these different patterns depending on what the topic is and what the impact is. Interestingly, Elijah De Palma, who's a really high-end quant at Thomson Reuters. He was at Thomson Reuters. He's moving on now, but he did some great research where he found that when high-impact news like a merger announcement hits on the Reuters alert system, that if there's a strong buzz in social media around that period of time, you have less time to get into the trade. You have to execute it much more quickly. Versus if there isn't much buzz in social media, you have plenty of time. There can be even up to a 2-week drift in the stock price that you can capture. So there's actually quite an interesting interplay even between news and social media, and how events, if they aren't reacted to in social media, tend to actually have a nice long lag and a momentum. Versus on other times, and it's a good question you have about trends versus mean reversion. It really goes back to prospect theory, which is won the Nobel Prize in 2002 for Daniel Kahneman, who's a psychologist, but he won the Nobel Prize in economics. He shared it in 2002 for this idea that as prices are declining, we tend to take more risk. So we tend to be willing to double down on our bets. But then it reaches a point where our reference point, where we usually think, okay, things are declining, but they'll recover. It's okay, they'll recover. But then our frame of reference, our belief system changes, and we start to think, well, wait a minute, maybe this thing is going down to zero. Maybe I'm going to lose everything in this trade. I've got to get out. And so by shifting our reference point down to zero, we think, well, I'm just lucky to have any money left at all. And we suddenly cut our what we believe are our winners. We're like, well, at least I've got money left. So we actually revert how we're thinking about this from trying to make back a loss to I better just take the little money I have left. And that switch in reference point leads to the capitulations that we see in markets, which leads to the mean reversion bounce. But as long as people think that the market will recover, with oil prices, we saw this as they went from $100 down to 20 for a long time, or 25 or 26. Anyway, as they were declining, people were saying, oh, it'll recover. It's okay. It's just a temporary blip. And it wasn't until they just finally turned around and said, wow, this thing could go down to $20 that it finally started to form a bottom. So you see that in the language, and that's really the type of thing that we pick up on, is this psychological turn of events as belief systems change, as people go through this cycle. And so to answer your question, mean reversion happens when a move is associated with a large amount of fear, when it's a sharp move with a lot of fear, like a sharp move downwards, for example. Trend following is associated with a steady increase in a certain type of information, like a steady increase in positive news, or even a steady increase in negative news that'll lead to a negative trend. But when it reaches a climax when people capitulate, right? But the great thing about sentiment data is you can measure it. You can see the capitulation happen, and you can thus generate much better indicators on when to follow the trend and when to use a mean reversion strategy. That's really the advantage of sentiment.
Okay. Oh, thanks, Richard. That's really interesting to hear about that. Now, what about environmental factors? What type of environmental factors can have a large-scale impact on sentiment?
Well, there's, one of the most famous ones is the length of day, so daylight. Is that the type of environmental factor you're referring to?
Yep.
Yeah, so that's a big one. Another one is solar flares or geodesic storms. Or geomagnetic storms, sorry. So, but I'll talk about the length of daylight is interesting because there was a study called seasonal affective disorder in the markets, something along those lines. Lisa Kramer, Kramer is one of the authors. Very interesting study. Anyway, they find that if you look at markets by latitude, this old adage of sell in May and go away is actually quite accurate. Not only does it extend back to the 1600s in the UK, where you have much higher returns from November 1st through April 31st than you do from May 1st through October 31st. But you actually, this effect gets stronger the higher you go in latitude. So the largest major market in northerly regions is Stockholm, and in the southerly regions it's Sydney. And to the extent that if you were to buy Stockholm on November 1st, hold it until April 31st, and then on May 1st, buy into Sydney, hold Sydney market, until October 31st, you'd have about a 20% average annual return over the period that they studied, versus about a 13% average annual return if you just held each market independently. So that's one of the largest and most interesting effects that's most backed up by biological research as well. So I find that a really interesting finding. 20% return is nothing to sneeze at, especially these days. And it's all based on, just rotating from market to market.
Yeah. Now, in your book, Trading on Sentiment, you've got a number of other interesting approaches. For example, arbitrage opportunities based on the management leadership team, as you mentioned, or stability of companies and government. So there's a lot of areas for sentiment analysis there. Where do you think holds the most potential for future research and applications?
Oh, that's a great question. There is going to be research on this area for at least a decade of intensive research because there's so much to do. There's going to be a lot of research on this idea of which individual authors are the most predictive. Can we get a basket of them, and can they remain predictive over time? There was a famous company, MarketPsych, that had a mutual fund that did very well from about 2003 to 2007, and then it completely blew up. I think it was down 90%, and it was closed. And they were following the best predictors in their online stock ranking system, who were basically buying beta. So they doubled the S&P for 4 years, and then people lost almost 90% of their money. So that's the risk that you take, but I think there's probably something to it. I think we can find robustly, this alpha capture system where we find the best predictors. I think that's one thing that's very interesting. But it's a lot of effort, and whoever does it, I wish them luck because it's a lot of work. And I know that some big firms are actually looking at this too. So that's an interesting area of research. And then secondly, I think images are going to be an interesting area of research. And then thirdly, artificial intelligence, because ultimately AI systems can understand and process this data much more quickly than a human can, and can make much better sense of it. So I think when you have massive big data like we have with sentiment analysis, we have to use AI systems to actually make sense of it and make it useful for traders.
So for someone who wanted to get started investigating sentiment analysis in trading, what would you recommend they do?
There are some free, I think there are free data sets out there, just simple positive and negative data sets derived from Twitter and other places. I think Quandl probably has some. It's worth checking them out. And, a lot of them are teasers, so you don't get much. I think you get a little data, and then you have to pay for it. And then we have data, with free data trials through Thomson Reuters. But for independent traders, it's not cost effective. That's a good question. I think there are some people with fairly inexpensive sentiment data, but it's low quality. And the reason it's low quality is that it's very, very difficult to do this well. I mean, every month we have to update with IPOs and name changes and mergers and acquisitions for thousands of global companies. I mean, every month it's maybe a couple hundred, but global companies, and that's a lot of work. You have to keep track of everything. You have to keep track of index additions and subtractions, and it's a lot of work to do this well. And companies that aren't charging much money for it probably can't support the operation. So that said, there are free data sets out there, and it's worth exploring, but it's tricky too. It's very noisy data.
Okay.
And naturally, I recommend my book.
Oh yeah, of course. Yep.
I wrote it to try to make sense out of all this academic research. Google Trends is in there. Academic research on Twitter. So I tried to make it impartial, but also it just isn't, because our data set is so much more comprehensive, I think, than a lot of the others. So, and I know it better than others. So I spent a lot of time on our data set too.
Yeah, I should also mention that we've been kind of talking conceptually today, but in your book, you've got a lot of studies and examples there. So, there's a lot of applications in there for people who want to learn more about it. So I think that's also a good thing to check out. And I'll have a link to that book on the show notes page for this episode as well, so people can find it easily. Now, a final question before we start wrapping up. What does sentiment analysis say about the current state of the US markets?
Good question. I'd have to look. I think it's it's negative right now, but I can't tell you in 12 hours what it'll be. So it depends on how the news changes, right?
Yeah.
Okay. I can tell you it was negative for the last 2 days on a daily model. Then there's longer term models. Our longer term models are also negative, but our short term models were positive until about a month ago. Last I looked was about a month ago. So I don't know. I can tell you for the next 12 hours they're negative. That's all I can tell you. And I know you'll publish this like 2 days from now, so it's pretty useless.
Yeah, actually, I didn't think about that. Good point. Yeah. Okay, great.
Yeah.
Well, we start wrapping up with some quick closing questions. I might adjust these a little bit to ask about sentiment analysis. So, what's the biggest lesson you've learned through studying sentiment analysis?
That's a good question. The biggest lesson I've learned, I guess, is it's really, really hard to both create good sentiment data and to find value in it. So it's not something that's easy to play around with. You won't find much value in this data unless you use nonlinear systems and know a lot about human behavior and information processing. It's very difficult data to use. So that's a disclaimer and a warning to anybody who wants to get into this area.
Yeah. Okay.
Yeah, I've spent 12 years on it, and there's so much more I want to do. I mean, we're just cracking the surface.
So, what do you think is the most important ingredient to becoming successful with sentiment analysis? A
good question. I think that an understanding of how people think and behave in markets in different regimes, bull and bear markets, is important. A lot of this is in my book, so I'm just sort of rehashing some of these lessons, but I think that's very important to understand regimes. I think it's also important to understand you don't have to take the traditional approach. There are a lot of people who recommend using Google's parser, like Parsey McParseface, or some of these really excellent tools. And it's a great tool. But if you're jumping into sentiment analysis and you start using those things, you will be lost for a year or 2 years just trying to set up your systems. So start with something really basic just to see if it makes sense to you, and then start learning from there. But again, it's very difficult. For us, it's been over a decade of work as a team.
Do you have any favorite trading books?
I like the Stock Market Wizards books because of what they say about, there's universal principles in there about human behavior in markets that I think are very interesting. Some of them are a bit showy, but, the general lessons are quite good. And then, there are some others that, it's difficult. Trading books are very difficult because to be a good trader doesn't mean you're a good writer, for example. So they're not always so easy to read. So yeah, those are my favorites. I'd say the Stock Market Wizards books.
Yep. Okay. All right. And what's the best way for listeners to get in touch with you?
Email address is best. It's richard@marketpsychdata.com. Or through our website, which is marketpsych.com, marketpsych.com.
Yep. Okay, great. I'll have that information on the show notes page anyway, so people can find that easily. So thanks so much for your time today, Richard. I found it really interesting to talk to you about sentiment analysis. Now, is there anything else that you'd like to mention before we finish up?
No, I think that's it. That works.
Okay, great. All right. Well, thanks again for the chat. It's been fantastic speaking with you, and appreciate you spending time with us today. So all the best.
Yep, my pleasure. All the best to you, Andrew. Take care.
Cheers. Thanks. Bye.
Bye-bye.
A big thanks to Richard for taking the time to chat with us about sentiment in trading today. If you're interested in learning more about the applications of sentiment in trading, I do recommend you check out his book. I personally learned a lot from it, so I've got a link to it on the show notes page, along with links to other resources that we mentioned today. So head on over to bettersystemtrader.com/57 to get more details. Also, make sure to check out our sponsors page, marketsystemanalyzer.com, for a fully functional 30-day demo of their software. Anyway, that's it for this episode. I hope you enjoyed the chat with Richard, and I really look forward to catching you at the next one. Thanks for listening to Better System Trader.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.